Volatility on gold is almost 2.5 times that of the S&P 500, so it's no longer store value.
Unprecedented volatility is shaking global markets as the war in Iran drags on. Concerns are growing that 20% of the world's oil supply flowing through the Strait of Hormuz could be blocked for a prolonged period.
Don't underestimate the tenacity of Mr. Trump as we approach an election, and of the U.S. military to clean up things. It might be the kind of year we're supposed to sell the opening and buy the close.
To understand what that all means for asset prices, how policymakers could respond, and the potential impact on Bitcoin, we talked to Mike McGlone, senior commodity strategist at Bloomberg. Before we start, as always, remember this video is not financial advice, only educational content. Also, if you enjoy our interviews, don't forget to smash the like button and subscribe to our channel. That will help our growth. I'm Giovanni, let's get started. You were commenting on the crisis ongoing in the Middle East with the attack on Iran, and you were saying that this is a tremendous opportunity when it comes to the markets. So what did you mean by that?
For tactically orientated traders, that's been my focus all year, is stay away from being long risk assets and look for opportunities to buy or sell assets at either a discount or a premium. And so my base case so far remains this year that stock market volatility, which is still low, it's picking up a little bit, will go up this year, which means a lot of opportunities. So we've had a few already. And so far, unfortunately, they've been mostly selling risk assets like Bitcoin. I'm beginning the year just below 100,000. It's obviously gone down. Silver above 100, it's gone down. Copper above 6, it's gone down. And now we have crude oil reaching 120, and that 120 high in both Brent and WTI, right about 120 on Monday morning or night. It looks very similar to the high around 130 in 2022 and the high near 147 in 2008. So that's the way I look at it. This is more of a year to, I think, to be kind of similar. I look at it as like it's shaping up like 2008, where risk assets will go down, and I look at it as an opportunity for the tactically oriented, which is typically what benefits commodity traders.
When you mention risk assets, the difference, I think it's that now pretty much every asset is a risk asset, as far as I understand.
Yeah, I think you nailed it. Exactly, Giovanni. When you look at the ancient store value, scoring gold, typically trades a lower volatility S&P 500. Right now, 180-day volatility on gold is almost 2.5 times that of the S&P 500. So it's no longer store value. Now it's a speculative risk asset. And that spread, that volatility between ancient store value and the stock market is about the highest in almost 20 years. And it's near the highest it ever gets. So I'm worried about all this volatility in crude oil and energy, natural gas, and precious metals trickling up to the stock market. And I think that's just getting started. And that will be all that matters if that happens. I think it's really a matter of time, but is it this time?
And so, compared to previous historical oil shocks, how significant is the current one that we see today with the Strait of Hormuz being blocked and the recent spikes that we saw in energy prices?
Well, that's the thing. You mentioned it. I did not expect that we'd have the first ever closure straight on Hormuz, but that's happened. It is still closed at the time of this recording on March 11th. That's a bit of a shocker. It's a major, I would say, faux pas of the U.S. military to have that happen, but it needs to be opened up. But what it's doing, it's shaking up the world order. And what it did is it spiked prices, flushed out all that, and did a massive short covering in an enduring bear market. And yeah, we're hearing about some supply constraints and bottlenecks of supply from the Middle East and the Strait, but that's 20%. The vast majority of the incremental increasing supply versus demand is in North America, most notably US. And I saw a story today. This is going to increase that widening disparity and ultimately make prices go back down. But that's a key thing to remember about crude oil. It's one of the world's most autocorrelated assets. When it goes up, it can be its own worst enemy because it causes recession and discombobulation, what we're seeing like now, that makes it go back down. So I look at it very similar now to earlier in the year. I thought, Bitcoin was decent resistance, copper, decent resistance, silver, decent resistance. And now it looks like crude oil's reached a pretty good peak for the year. Even natural gas. So I'll end with this. So I'm predicting that this pump in crude oil will do very similar to what it did in 2008. It pumped up to 147, and the low in the year by December was 32. We just did that in natural gas. Natural gas in the US pumped up to 7 in January and then dropped down to below 3. That was 100% rally and now back down in the year. I'm predicting the similar in crude oil. Right now, as we speak, it's up almost 50% in the year. It was up 100% in the year. And I think by the end of the year, it's going to be below $57 a barrel, which will be down in the year. And the key reason, part of the key reason for that, Giovanni, I'll end with two key things. One key thing really is it's just one of those lessons I've learned is don't underestimate the tenacity of Mr. Trump as we approach an election and of the U.S. military to clean up things.
Okay, yeah, that's what I wanted to discuss because as far as we see now, there is no end in sight to this military operation that is being carried out by Trump. This crisis might continue longer than we expect. What makes you so confident that the oil prices will stabilize?
Well, let's talk about the rest of the world's oil, 80%. You're talking about 20% in the Middle East, but also most of that oil goes to China, 50%. And the connection between Iran and China oil right now, I think, I understand, it's still there. They're still moving that oil, but it's under the transponder radars. It's Chinese ships. But so the bottom line is that's a recessionary trajectory for the rest of the world, but it's going to accelerate the pre-existing trends that's been pressuring oil, and that's supply led by the U.S. So one good example is OPEC exports around 19 to 20 million barrels a day. Now that's 20%, maybe 25% of global supply with OPEC plus. But the U.S. and Canada have a supply versus demand surplus running almost 8 million barrels a day. The last time we've had kind of shocks like this, that was much less, or it was a deficit. So that's the shift in the world order. And also what's Mr. Trump doing. He's already started to, harness a little bit of energy in Venezuela. And he has pre-existing trends in his favor. That's why I was pointed out before. It's just there's a glut of energy. But the key thing is not just oil. We have a glut of grains in this country too. And we have to find out more demand sources. And one of the primary sources of demand might be biofuels, which means more energy coming from the US. So something really bad has to happen and stay bad in the with the war in Iran to really cut off that supply. Right now, we're seeing bottlenecks, which actually might accelerate that bear market. So you pump prices up, you flush out the shorts, and you go back down. That's what happened in 2008 and 2022.
I know that you anticipate a deflationary environment that will come soon. On the other hand, I wanted just you to comment on something that I read on the news today from the Bank of America. It came out with a statement saying if oil continues to remain high, the Fed may be forced to cut interest rates. The rationale here is preventing a recession and supporting economic growth. What would be your comment on that?
The number one reason to cut interest rates in this country is the stock market going down and creating that deflation from inflation. Right now, we're just stagnant in this mode that, well, we've recently had to take some tightening, some hikes, some cuts out of the market, potential cuts, because the spike in oil prices means inflation. That's the Fed's mandate. So cutting rates into inflation is kind of an oxymoron, but let's remember that's what they did in 2007 and 8. Inflation spiked in 2008 around 6% when oil spiked, and they're cutting because the whole economy was tilting lower. But the 10 on the scale for the Fed to do anything is the U.S. stock market because it's 2.3 times GDP. If it moves 10%, that's almost 25% of the economy. That's 10. That's what really matters. If it goes down, the Fed will cut a lot in no problem. If it stays up, inflation will stay sticky, which it is now. It's getting stickier, and they'll be out of the game. But I'm not. You can ask Bank of America with more details about that. And that's my views on what's going to happen to the Fed.
We had Arthur Hayes on our channel not long ago, and he mentioned the fact that this war in Iran is likely going to lead the US authorities, the Fed, to print more money, to increase the balance sheet, and basically to pump liquidity into the economy because of the spending that this war is going to cause. What would be your response to that argument?
Wow. So what's his conclusion? What are we supposed to do? And what's the strategy as a strategist? Because that makes sense. That could happen. What does it mean for markets? That's the key question. So that could happen. The bottom line for The Fed right now is unemployment's going up, but stagnant but heading higher. And right now we're seeing a little uptick in inflation. So they have that's a bit of a connection for them. But I pointed out why I think they're going to be easing. Things you mentioned like that are very inflationary, and that's the number one way to not get elected in this country at the moment.
So you mean that the priority number one for Trump is keeping the inflation lower, therefore cutting interest rates would be counterproductive in that sense.
Cutting interest makes inflation higher if you do it in the wrong environment. So there's a difference. The number one, so let's point out facts right now. Now we're having this Trump initiated this invasion at the end of February. Remember, midterms are in November. That's when he has to really worry about Republicans getting pushed back in the elections. Inflation was already ticking down. It was running 2.4% CPI. Now it's going to tick up with this environment, but just have to look forward from this. You have to expect this incursion by the U.S. military to go very poorly. And right now, I think it's already really bad that the Strait of Hormuz is still closed of almost 2 weeks. That's really a bad thing. But that's probably the fog of the war, unless it gets really worse, which I doubt it will. Usually American firepower just keeps turning it up until they vaporize stuff, which is sad. But this is where we are. And typically by this time in the cycle, having, traded during the Gulf War and other events, is by this time of the cycle, it's usually that cycle heading lower in terms of crude oil prices. But again, I can't predict wars. This is unlikely that the offensive capabilities of Iran are going to get increased at all from this. I mean, I think they're going to completely just get decimated.
Yeah, it looks like for sure the US has the upper hand in this conflict. Right now, we have a very interesting environment where you have record volatility in assets such as energy and precious metals versus an unusual lack of volatility when it comes to stock markets. And you believe that's an important signal. Why should people pay attention to that?
Yeah, well, what's put in this combination is very unusual. We have collapsing cryptos. Bloomberg Galaxy Crypto Index is down more than 50% from the peak, and Bitcoin. We have surging volatility in precious metals. Gold's 180-day volatility is almost 2.5 times that of S&P 500. That's the highest in 20 years. And we have surging volatility energy. And yet we have stock market still ticking unchanged on the year, maybe down slightly. That's very odd. So for it not to have more volatility trickle to the stock market. And to me, that's the key theme here, Giovanni, is we're probably peaking in the stock market. We're probably going to just start the first 10% correction we've had in a long time. And maybe stay down. And that's your source for the Fed to ease, for interest rates to potentially drop, and for inflation to go lower. Now, if it's because of a spike in crude oil, that means recession. And that usually means it'll just go down more later. But again, that's what's changed from the history. The questions are the same, the answers have changed. Certainly from a U.S.-centric standpoint. Let's look at what's happened. The leader of the world's largest energy and natural gas net exporter has attacked Iran, a net exporter. And this leader of this country, U.S., wants lower energy prices. He's going to get them. And just this is part of that fog. And partly the key thing to remember is oftentimes you get lower prices because they spike too high. Now, that's the reason we're in a bear market. Prices went up too much to the peak in 2022 around 130. We've just flipped that, maybe going back again. And same things happen in grains. Prices have been going down because they went up too much and just incentivize more supply and they curtail demand.
Basically, when you mentioned this drawdown that we are probably going to see in the stock market, you mentioned a 50% drawdown. Why do you believe it's going to be so severe? And what do you think is going to be the impact on crypto?
Well, if cryptos are leading the way. So that's why I fully expect things like Bitcoin to probably head towards its enduring mean around 10,000. So here's what we have. We had the biggest money pump in history, pumped up all risk assets, crypto led the way. Now they're leading lower. And let's add on to that. Last year, we had this most significant year for gold since 1979, grabbing alpha. I mean, it's almost a 50-year event. And now we have at the beginning of the year, we had natural gas jump up 100%. Now it's down 15%. And we had crude oil just a couple of days ago drop up 100% the year and it's dropped 50%. See all that volatility? We have historic volatility kicking in many different places, historic indications. Yet that stock market volatility is 180 volatility is running at almost a 10-year low, and the stock market captive GDP is running the highest in 100 years. that's all signals for a little bit of reversion. And that's why I'm saying just another 50% correction. This will be the third since 2000, partly because we're the most expensive ever in stock market versus GDP. And we have those, I mentioned the indications. I just point out when you can make statements like, back in January, silver reached its highest price ever versus copper um, and uh, and crude oil. That is just very rare. So those are signs of the volatility we're seeing, and we're just still absent. We still haven't seen any in the stock market. So that's just, to me, a rational iteration to expect in markets.
And just to clarify this, since Bitcoin is usually sort of front running these movements, I guess that you expect the Bitcoin crypto market to bottom out before the stock market does.
Typically, yeah, but it typically takes the low price cure. So let's talk about how that usually works. We have an excess supply of cryptos that was really brought on by the big spike in prices and by the enthusiasm of Mr. Trump's election. The bottom line is the next really source of a recession is some reverse wealth creation. We had so much wealth creation, we're just starting to reverse that. Um, and cryptos are great leading indicator. Again, the key thing to remember that most cryptos are just speculative trading instruments. Oh, that's fine. I'm from that environment. But there's really no underlying fundamental value of things like Dogecoin. And as we tokenize and things come on chain, we realize the value of this technology to track the dollar via stablecoins, which is awesome. We're going to realize all these other tokens that track nothing will probably gravitate towards zero.
Yeah, that's a great take. I agree with you. So Bitcoin peaked, gold and precious metal peaked, oil already peaked. The only asset that could be the best trade to go long on could be the US bond market, correct?
Yeah, I'm still sticking with Treasuries for the year. Been my bias so far, so good. But I'm glad you went there because I look at it, it might be the kind of year we're supposed to sell the opening and buy the close. And the bottom line means for me is I just fully expect stock market volatility to mean revert higher this year. That's my base case. It still remains that. So the levels remain the same. Now I kind of move my level for good resistance in Bitcoin down to 74,000. I still have copper around 6 is a really good resistance. Silver around 100 is good resistance. And now we see crude oil 120. You look at further out, the key thing about crude oil is the remember is you have to skate to where the puck's going. So what futures contracts will be front month right about the election. Now they're trading around $70 a barrel. So that might be the key level to look to, those further contracts to go lower from. But all that to break above all those levels, a combination of that, even 10-year bond yields, the high yield for the Treasury 30-year this year is 496. It can't get above 5%. For all those markets to go higher, I think you need stock market volatility to stay very low and lower. And I think it's going to go up. Stock market volatility, that is. So that's part of the levels they put in. And by the end of the year, maybe I'll end it with this. This year's turning out to me similar to 2008. Remember we had that big energy spike, 2008. Volatility was very low at the end of 2007, and things just remain reverting.
Yeah, that's clear. Thanks a lot for coming to our show.
Giovanni, always thank you for having me.